All right, everyone. Thank you for joining us today. This is Lori from Minnesota Realtors. And welcome to the webinar presentation of Becoming a 1031 Exchange Expert to Grow Your Business. Today, we'll have the opportunity to learn from a fantastic panel of experts, including Jeff Peterson, a highly respected adjunct tax law professor at Mitchell Hamlin School of Law, and as president of SPEC1031.com with over 20 years of practical experience. Mike O'Toole with Discipline Advisors. Mike has over 15 years of real estate and investment securities experience, 10 years of which with an investment real estate and Delaware statutory trust sponsor firm. Mike advises clients with investment planning with a focus in real estate, 1031 exchanges, and other financial planning and estate planning needs. And finally, Dan Wagner, Senior Vice President of Government Relations at the Inland Real Estate Group of Companies. Dan is Senior Vice President of Government Relations, like I just said, and has been licensed real estate broker since 2004 and holds Series 7 and 63 security licenses. And I'll let you guys take it away.
Thank you so much, Lori. Welcome, Minnesota Association of Realtors. Thank you so much for having us today. I got to first do a shout out to the leadership team, Bob Clark, the president, TJ Simon, the president-elect, Jason Miller, treasurer, and Matt Lascota, the immediate past president. Of course, the folks that are running the show with Chris Galler as a CEO is a great person. Carrie Anderson, Senior Vice President of Member Services, and Lori Gans, you are phenomenal. Thank you so much for putting all this together. And then I got to do a couple of points of personal privilege. Jerry Thiessen, I love you, and Jim Cormier, and of course the person that needs no introduction or anything is John Smaby, one of the rock stars of Minnesota. So it's great to be on this call with all of you today, and I think you're gonna we're gonna have a really good presentation. So I'd like to just first start off and get into just a quick rundown of my company. It's the Inland Real Estate Group. It was founded by 4 teachers. These teachers came from nothing. The guy in the middle is Dan Goodwin. He's a chairman and CEO, and his dad was a machine tool shop guy. That guy next to him was Bob Parks, whose dad was a janitor. Bob Baum's dad, he's our chief legal counsel. His dad drove around to gas stations selling auto parts. And then Joe Cosenza's dad was a barber. So they came from nothing. They were Chicago public school teachers. They, in the summers, got other teachers to give them money to invest, and they got really good at it. And they created Inland, and they left teaching, and the rest is history. But we are, Inland's been over 50 years. Now I think it's their 53rd year. We're the owner and operator and manager of institutional quality real estate, doing lots of different, every aspect of commercial real estate. And we have about 1,000 employees with all these different companies. And one of the things I wanted to highlight why the 1031 is so important to our company is in the 80s when the tax laws changed, these teachers had up to 42,000 apartments in Chicago. They were the largest landlord of Chicago. And the tax laws stopped in the 80s, stopped limited partnerships from doing pass-throughs. So a variety, some of these deals were underwater. And kind of like It's a Wonderful Life moment, these teachers wouldn't allow people to go bankrupt. So they went to Walmart and they put all their money back in the company and they said, hey, can we do sale leasebacks with you, Walmart? Walmart said, yeah. And then they went to Treasury and they said, hey, Treasury, we want to, can we 1031 like-kind exchange these underwater investors into fractional share interest of these Walmarts? And they said, nobody's really done that before, but okay. Well, that was It's a Wonderful Life moment, because once they did that, the investment community went nuts and said, nobody's ever done this before. And so they just went to the stratosphere. They've now purchased over $47 billion of commercial real estate for different investors. So that 1031 has been a part and parcel of our company. And we got into the tenant in commons, and then my boss, Dan Goodwin, working with lawyers, put together the idea of working with Treasury, and they created a thing that's better, and that's the Delaware Statutory Trust 1031, and that's what we're going to get into today. But before we get into the DST, we do have an honor to have Mr. Jeff Peterson, who's a terrific guy. What highlight before I forget, one of the things, the reason why the 1031 continues to exist in such strong fashion are these different organizations, but the most important organization is the National Association of Realtors. We had over 10,000 realtors walking Capitol Hill to save the 1031. And one of the reasons why the realtors are so important is RPAC. Make sure that you donate to RPAC as a member of the association. And if you can become a member for $1,000 of RPAC, that would be terrific. So just to highlight, the realtors are super important to keep the 1031 going, which is near and dear to Jeff's heart. And Jeff, if you could kind of first explain your company and what you do, and then tell us what a 1031 is.
Well, thank you. It is a pleasure to be here with this esteemed group and to talk to you about my passion, which is helping people defer taxes and continue to compound and build their wealth in real estate without the drag of taxation. And while a lot of the focus of this PowerPoint in this presentation is about inland and DSTs, you know, the bulk of the exchanges that I'm involved with and are just routine mom and pop exchanges where people are selling maybe a duplex and they're exchanging up into a fourplex, and eventually they want to exchange that fourplex for a 12 unit. And eventually, over time, over the course of 30 or 40 years, they can compound and amass a lot of real estate. And if you think about it, when I see construction cranes in downtown Minneapolis, and I see buildings going up in Bloomington and Eden Prairie, I see jobs, I see material suppliers, laborers, I see housing stock being increased. And the reason that I think 1031 exists in the code, and correct me if you think I'm wrong, I think it stimulates the economy organically. It allows capital to flow to the most advantageous investment that creates jobs, that creates increased housing values and property values. And everyone benefits when we stimulate real estate. Oh, by the way, real estate agents benefit as well. So do title companies and banks and everyone that is involved in the velocity of real estate. So 1031 was modified in 2017. And it was limited to just the exchange of real property. Before that tax reform occurred, we could do exchanges of business equipment, non-real estate like aircraft and tugboats and train cars and all kinds of other non-real estate. But now, presently, we can only exchange real estate. Well, why is it that we can only exchange real estate? It's because your lobby, the National Association of Realtors, the farm lobbies, and other powerful groups got a hold of Congress and said, hey, you cannot get rid of 1031 completely. It will stifle the real estate economy as it occurred in the 80s. In the 86 tax reform, real estate went into a doldrums because they had removed some of the underpinning financial and tax incentives for real estate. So what do you do when you do a 1031 exchange? You're not cashing out. You're taking all of your proceeds from the sale of your old relinquished property and you're rolling those monies through a qualified intermediary and redeploying those dollars, those radioactive dollars, into the new replacement property. Both properties in an exchange have to be held for investment or business purposes. Business or investment is the sort of strike zone that you have to be in. And you'll note on this PowerPoint slide, it says not a primary residence. It should also say not also a flip property, a property that's held primarily as inventory, your stock and trade that you're selling. So flips don't qualify either because they're not held for investment or business, they're held primarily for resale. On the slide, it says you can't do exchanges of stocks and bonds. And for many years, when we had a 1031 exchange, highly appreciated property, lots of gain, and you talk to a financial advisor, the financial advisor would be, hey, sell the property in a taxable transaction, give me the money, and we'll work it, and we'll make up the lost equity that we gave up in taxes. Until companies like Inland developed a strategy to bring that equity from the sale of appreciated real estate into a managed asset that's management free, relatively stable and steady, and can give the taxpayer a management free option that's not as labor intensive as owning and managing real estate. And when you think about how much time you spend on your buildings, how much personal energy you spend to manage your real estate, and then think about how you can get a similar or even better return without your active participation, the inland type of assets start to look very attractive as sort of that last stage in the wealth building strategy. You start with a 4-plex, you move to a 12 unit, you get to a 36 unit, maybe you get 100 units. But at the end of your run, you want to be able to enjoy your retirement without having to pay the taxes. And a product like Inland is a wonderful way for you to move your wealth into a less management intensive form of real estate that, by the way, is designed, and Dan, you can tell me if I'm wrong, but this product was designed to qualify for 1031. That's its sole function.
Yes. And let me jump to a couple more slides here, Jeff. Could you explain, if we're a $1 million property, what are some of the taxes that are taken out of that when it's sold?
Well, when I think about a 1031 exchange, I think about 3 elements. I think about what is your value? What are you selling that property for? Because you generally want to exchange into properties of equivalent or greater value. Okay. Next, you want to reinvest all of your equity or net proceeds into that property. And lastly, you are going to pay off mortgages or debt on your old property. And you need to offset that debt relief with new debt on the replacement side or cash in out of pocket, but no one wants to do that. So I'm just going to go off script here, and I want to talk to Mike for a second. What are the advantages of the debt that's associated with the DST when I'm offsetting my debt relief from my old sale?
So thanks, Jeff. The biggest advantage of the debt is that debt is 100% non-recourse. So Inland does a great job of working with their banks and lenders and structuring any loan to be 100% non-recourse. And what that means is we are not, as investors in the DST, personally liable for that debt. We're not signing any bad boy carve-outs. We're not on the hook. We're not on the loan. Our name really isn't associated with that loan from a liability standpoint. Now, if we invest equity, that equity is always liable in a real estate transaction, but only that equity invested in that specific real estate offering. So go ahead.
Well, I'm just going to reiterate the point here is I'm exchanging out of real estate that I'm personally on the hook for. I've signed the mortgages, I've signed the guarantees, I'm on the hook, and I'm trading into management-free properties that I'm not personally liable for the debt, but I get to count that debt that comes baked into the replacement cake as my debt. My debt is my share or allocable share of the debt. So for tax purposes, I'm taking on debt, but for purposes of accounting, this is off-book debt that I'm not personally liable for.
Yeah, exactly. And we work with clients every day that's somewhat of the driving factor in what they're trying to do. Work with a lot of farm and ag clients, and they live their whole life with debt on their balance sheet and basically a slave to the bank. And they then go and sell, and if they don't defer these taxes, they wind up with not a whole heck of a lot after they pay the bank off. So this is a way to shift that liability off their balance sheet.
Farmers totally get whipsawed because between paying off the bank and paying off the state and federal taxes, they don't have much to show for a lifetime's worth of farming. So let's get to this, the meat and potatoes of this question. When you sell appreciated real estate, you've got maybe 3 or 4 different tranches of tax. You've got the tax from the natural appreciation in value, that increase in value that occurs over time, that could be called appreciation. Arguably, it's probably due more to the fact that there's inflation occurring and the value of real estate is increasing in relation to the declining value of currency, but that appreciation is taxed at a maximum rate of 20% federal. And then you get the state where you're located. Minnesota is like 9.85%. So on the appreciation, that tranche might be taxed at 30%. If you've got buildings, improvements, components that have been depreciated because of the theoretical wear and tear on the property, every year that you take a depreciation deduction on that property, you're getting a corresponding reduction in basis. So the other way that you're accumulating gains is that over time, your basis is incrementally lowering. So I might have paid $1 million for a property, but over 14, 15 years, my basis will have declined to maybe 500,000 because I'm whittling down my basis over time. That portion of the gain that relates to depreciation is taxed at a maximum rate of 25% at the federal level. And again, whatever the applicable state rate is, Minnesota doesn't distinguish between appreciation and depreciation, so it'd be the same maximum rate of 9.85. On top of that, there are other types of tax. There's the net investment income tax, NITA tax, 3.85, that can apply to portions of the gains, the profits derived from the sale of real estate. So you're going to give away a lot of your hard-earned equity if you don't think forward like a chess player and plan your moves to preserve your equity and defer those gains by transferring them into other like-kind property that you're going to continue to hold for investment or business purposes. As long as you're not cashing out, you won't get slapped on the wrist with unnecessary taxes, and you're going to be able to move that cash into the next investment.
Well, and that's where by the way, everybody, Jeff is absolutely one of the best QIs I've ever heard. So this is a special occasion to have Jeff on here. Jeff, you're terrific. To just the way that you've explained everything has been terrific. So clearly, you have more money to be able to invest with your 1031 exchange. And now we're going to jump over to Mike to talk a little bit more about the DST, to explain what that is. Then we'll go back to Jeff. But Jeff, you are the Carl Sagan of QIs with that backdrop there. So you look
Thank
good.
you.
Okay, Mike, let's talk about what is this concept. First of all, what are you, Mike? You don't work for Inland. Obviously, Jeff doesn't work for Inland. We have 3 separate companies. What do you do, Mike? And tell them, explain what a DST is.
Sure. So I work with a company called Discipline Advisors. We're based here in Minnesota, and we're financial advisors, financial planners. But the majority of what we do for our clients involves business and or real estate, estate planning and transitions, selling a business, selling property, retiring. So we utilize tax advantage strategies like the DSTs and the 1031 exchanges to work with those clients. So we have extensive experience in it. I think we've probably done close to $500 million of 1031 exchange work. So what is a DST and what really is this? A DST, simply put, is a trust, like many other trusts, that's formed in the state of Delaware with the specific purpose of holding real estate, one or more properties, and being able to satisfy Section 1031. And this all dates back to a revenue ruling, which is 2004-86, that basically says if you structure a DST or Delaware statutory trust in such a fashion, it should qualify under Section 1031 as like-kind property. So a DST really straddles 2 worlds, right? It functions and acts from a tax standpoint just like any other real estate or real property. But then it also is in the securities world, and it is sold through or invested through financial advisors. And it's structured as a Reg D security. And the important thing to understand is, unfortunately, based on the tax laws or the SEC laws, you need to be an accredited investor to invest in a DST. An accredited investor is someone that has $1 million net worth, excluding their personal residence, or they have 200,000 of annual income, single, 300,000 a year joint. So the real beautiful thing about a Delaware statutory trust is it is a passive investment vehicle. So as Jeff was talking about earlier, an investor can sell that 36-unit apartment building that they've worked their really whole working career to build equity in, defer 100% of those taxes that would be due, and go into a much more passive vehicle into a DST, or typically we're working with our clients to create diversification. Minimum investments on a DST are as little as $100,000. So we can create a diversified portfolio with really zero management responsibilities for each investor and mailbox money, to put it simply. And DSTs pay you once a month.
So Mike, the one of the reasons why you're able to do, compared to a TIC, a DST with $100,000 as a kind of a minimum is because the maximum number of investors for a DST is much greater. Can we talk quickly about some of the other benefits to ownership structure? And you can pass through depreciation and how that helps with possible tax shelters, and why the loan aspect of it, and also the property management. So you kind of touched upon those.
Yeah, absolutely. So a lot of us on this call, and I'm a licensed real estate broker as well, I should mention that, are familiar with tenants in common, or TICs, and sort of I call them the older programs. And some of them worked okay, but the reality is the structure, not necessarily the real estate, was somewhat flawed or has its flaws. So when the DSTs came about, what they really did is they offered a structure that's much more passive than a TIC, and really has a few high-level benefits I think it's important to point out. One, in a TIC, you actually have an undivided fractional ownership interest in the property or a deed. So you can have up to 35 investors that have title to this property. In a Delaware statutory trust, you actually own a beneficial interest in a trust, where the trust or the DST is actually on title or on the deed. But the very important part about this, and we talked about it, is these non-recourse loans. In a DST, the investors are not liable for that debt. In a TIC, they typically are, and they typically sign off, and the lender has to underwrite each individual TIC. So when it comes down to the ease of investing or getting a 1031 exchange across the finish line, a DST is much simpler to do that. And then as far as management goes, TICs are somewhat passive. You had a manager taking care of things, but ultimately in a TIC, each individual investor, up to 35 people, have a say in major management decisions. When to lease the property, who to lease it to, when to sell the property, refinance it. And as you can imagine, getting two people to agree on something is hard enough. 35 is very difficult. So in a DST, the trust manager, or inland, as an example, would make all the management decisions for the investor. And when we work with clients, I'm very forward about that. If you want to manage real estate and make decisions and be involved, that's great. It's a great way to create wealth, but maybe a DST isn't for you. If you're looking for something passive, mailbox money, and you're just looking to defer your tax, generate income, and ultimately a lot of our clients are looking to pass this real estate through their estate, a DST might be a good alternative to traditional real estate.
And Jeff, did you want to add anything?
Well, I will tell you, you live through enough economic ups and downs, the swings in the marketplace, and you see a lot of stuff happen. Those tenant in common arrangements that became stressed out because they had difficulties with tenants or difficulties with operations, and they needed to make decisions about selling or refinancing. They had terrible difficulty because they had up to 35 co-owners from all different parts of the United States collectively owning a property and trying to make a decision as a group. And to get unanimous decision making in that context where there's stress, maybe one of the major tenants has gone and left the building, they need to make a decision. It's very hard to do in the context of a tenancy in common. A big syndicated tenancy in common is a tough way to own real estate when there's stress. When everything's going great, they're great. But when there's stress, that's hard. I like the DST structure because you have one figurehead at the top, that's the trustee. So when you're going out and getting institutional financing, the lender really only has to work with one person, the trustee of the trust. So from management and from financing perspective, the DSTs are just rock solid. That's the way to go.
Hey, Dan, I'm going to jump in here. I saw a good question pop up, and someone had asked, what's the difference between a DST and a REIT? So I don't know who wants to take that one, but.
Well, that's a great question. A REIT is kind of like a blind pool. You put your money in it, and a REIT can buy billions of dollars worth of different stuff. DST is you specifically know what you're buying, and so it's going to be typically 1, 2, or 3 properties. How's that? And so let me jump into the DST phase of DST real quick, and I'm going to try to go through these quickly. So phase 1 is the acquisition and subscription. So like I said, Inland, we're over like 30% of the market of this DST world. And we have been in business for 53 years. So when we, Joe Cosenza, he's one of the founders, he's in charge of acquisitions. He's purchased over 3,500 different commercial real estate deals. He would win the Guinness Book of World Records of commercial individual deals of one person doing them. So we know the connections we have and stuff to be able to buy property is phenomenal. And then we have an entire property tax division, an insurance division. We have everybody that knows the property management. So our due diligence is absolutely unbelievable. And again, Mike, your company, because Dan Wagner can't sell this to you because I'm the sponsor. The person that can sell this to you is Mike, and then obviously to be able to do the deal is Jeff. So, Mike, does your company, you're not related to Inland, is your company, you guys evaluate our stuff too, right?
Yeah, we do. We look at the whole marketplace. So part of our job is our own due diligence. I always tell people there's 4 layers of due diligence that go into a DST. One, Inland and their extensive experience. They're putting their money on the line. Unlike a REIT and other blind pools that Dan talked about, Inland is actually acquiring the asset before they've ever raised $1 of investor money. It goes on their balance sheet. So they take more risk than anyone in this transaction. So with that said, with their own money, they're going to be very careful with their due diligence. But after that's done, we actually have a team of folks, analysts that review all offerings really in the marketplace, including Inland's. And if it passes their tests, I will look at the deal and work with our clients on that. We also employ a third-party due diligence firm, typically a law firm, to just look over our work and make sure that we didn't miss anything. So there's really 4 different layers involved in due diligence on a DST.
It's really the belt and suspenders of really looking out for your client. And then the operational property management and how it works. It's kind of we won't do a capital call. That's kind of baked into the cake, right, Mike?
Technically written into every DST trust agreement I've ever read or written. It basically says there cannot be capital calls, which is another difference we should point out between DSTs and TICs.
And so just could you rubber hit the road? How does it work as far as their clients in regards to do they receive anything? I mean, what's the benefit of getting a DST for their client? What do they get, like the monthly, if you can get monthly income, what's that typically? How does that look?
Oh, you're looking for returns, Dan? Yeah, so rental payments are paid monthly, and typical rental returns right now on a net, everything we talk about in the securities world is net to the investor. So on a net basis, you're looking at 5 to 6.5%, depending on the DST location, et cetera. But that's only the rental income. If you look at total returns, those can vary based on the length of the hold, the type of the asset, the business plan, the risk of it. So those really can vary. I can tell you, we've been doing this a long time, and our average returns, total return, is really in that 8 to 12% a year range. An average hold period is about 5 to 7 years. So DSTs are a longer term hold. They're considered an illiquid asset like any other real estate versus a stock or a bond or a mutual fund. But these aren't indefinite holds. The trusts are typically written to last 10 years. So the longest you would hold the DST is 10 years.
and it's non-liquid, and there's no secondary market. So, so really, that's why you have accredited investors, right? That people they should know that you just can't get the money out tomorrow, right?
Yeah, true. A DST is transferable, but the intent should be to hold it until Inland says now is a good time to sell. We've executed on a business plan. We've grown rents here. The value has appreciated. We're selling into a market of Inland 4, and they've done a great job.
Mike, question for you. You know, some people are razzle-dazzled by a high yield. They might be comparing one DST to another and say, well, this one's offering me 9% yield. Why would I go with your lower yield? And it seems that they get sort of fixated on the yield component, but they're not looking at the other side of the wealth building paradigm, and that's the appreciation in value, as well as the stability of the asset, because I could get you a really high yield, but it would be a risky concentrated position, and I may not get any appreciation over time because it's all focused on risky initial yield. So how does Inland's philosophy compare to the more, you know, higher paying DSTs?
Yeah, I mean, Inland is not chasing yield, nor are we, and that's something I have conversations with our clients very regularly about. Yield is important, but it's really a snapshot in time. It's an estimate. It needs to be, income needs to be durable. So if you're getting 9% for a month or two, you feel pretty good. But if that goes to 4 or goes away because you were too risky, and all of a sudden that didn't make sense. And the reality is, if that goes away, you've lost value. You've lost principal in the property. So I can tell you, based on our track record, and Dan, you know, can look at Inland's track record, a lot of times the best performing properties have lower yields. And the reason is those were properties that were purchased conservatively, and a lot of money was set aside through reserves in a DST, which DSTs always have reserves set aside up front for property improvements at the property level. So renovating units or releasing tenants, a new roof, whatever it might be, that is creating value, right, to our principal or principal appreciation. So over time, we look for both. You need to have income, steady, durable income, but you also need to have the potential for appreciation. So I would say our best performing DSTs have actually been some of the lower yielding ones.
It's counterintuitive, but it makes sense when you think about the big picture.
Yep,
If you look at real estate as a whole, the highest risk real estate is non-income producing real estate, where there's strong, deep value add. And DSTs are not that. DSTs are core, conservative, stabilized real estate. But to your point, Jeff, it does make sense that actually a lower yield can correlate to higher returns.
And I don't want to take us off track too much, but Mike, you have sort of an interesting pedigree in that you've worked on the sponsor side where they're acquiring assets, and you have sort of an insight as to how much experience the people that are out trying to acquire the real estate have and the connections that they have. So when you're getting into a DST, you're getting into an institutional grade of a class of property that mom and pop people probably just don't have access to, and you're getting that sophisticated infrastructure of the DST sponsor. It seems like it's a great value because you get so much expertise and so much access to the market that an ordinary run-of-the-mill guy could never get.
Absolutely. And then I think that's the allure of it is, you know, we have clients that will call and, you know, maybe it's a $50 million exchange. Those clients, DSTs may work for some or all of it, but the reality is the sweet spot for DSTs, and I think, Dan, you can speak this, why Inland created the product, was for your mom and pop, your traditional retail investor that didn't have access, but still wanted to benefit from these type of properties. So very regularly, I'd say south of $5 million, the DST solution is extremely powerful because you can build the diversification that you couldn't otherwise buy in with one property. So.
Let's get zooming along. The 1, 2, 3 phase of DST, and I do want Jeff to talk about the types of DS or of 1031s, what you can exchange. Like, for example, can you exchange? I rent my yacht out, and can I exchange that? So talk about some of the exchanges here.
Well, we can do exchanges of real estate. So if you want to take that yacht and permanently affix it to the top of a house, then we could probably do it because it would become real estate. But generally speaking, you can't exchange personality, chattel, non-real estate. But we can exchange any real estate in the United States of America for any other real estate, generally speaking, in the United States that's held for the qualified purpose of investment or business purposes. We are seeing people running around like chickens with their head cut off because the deadline that was extended for the identification period because of the COVID was extended to July 15th. And as of the date of this recording, July 15th at midnight tonight, there's a lot of people whose identification periods are about to lapse at midnight tonight. So they're looking at deals and they're trying to figure out what to identify, but they also have to be worried about what they can actually close on. And with the DST, you don't have to worry about qualifying for financing, dragging your banker uphill with you to get a deal done because the debt's already baked into the deal. I love real estate exchanges. I love helping the economy grow. I was telling Mike the other day on a call, I feel like my job as a humble servant of capitalism is to help this economy heal by creating as much velocity in the marketplace as possible and to get as many deals done as possible so that we can build back jobs and we can start to gain momentum in the economy after the shutdowns that have occurred. So I'll let Dan take it from here.
Yeah, and then Mike, can you talk about the different kind of DST opportunities and what, like, they're not in one, necessarily just one state, they're all over. Can you talk?
Sure. So a DST can really own any kind of real estate, but there's certain types that work much better. And really any asset class can work, but we see, as you can see on the screen here, all different types. Certain types work better. If you look at multifamily housing, that makes up about 50% of the DST marketplace. Some asset classes you don't see as much of, especially anymore, is not as much retail, not as much hospitality, although it works. And depending on the office properties, you don't see a lot of skyscrapers or downtown commercial business district offices, but you might see corporate campuses like the one on the screen here. The ESPN North Campus is actually owned in a DST that Inland manages. And it can really be any geography, but typically you're seeing DSTs in the path of growth, or where these companies such as Inland feel that the best opportunities to own real estate long-term is. And that tends to be more so in the southern United States right now, but they can really be anywhere.
And now we're going to get into more to Jeff. If you can kind of get into, is it, have you ever experienced somebody saying it's, I'm ready to do a DST, and just, is it ever too late? And then we'll get into the timeline. So Jeff, really the floor is yours for the next few slides.
Well, sure. I mean, I often tell people if it wasn't for rush business, I wouldn't have very much business, because people come to me last minute. They say, hey, I'm selling this appreciated real estate, and somebody told me I should talk to you about a 1031 exchange. I've never done it before, but I don't want to pay taxes unnecessarily. So I get lots of people coming to me right before the sale of their relinquished property, and they haven't had time to even get up to speed on how to do a 1031 exchange. So having a really good qualified intermediary, relying on your own accountant and your own attorneys, and building that team can be very important to take the first step in a 1031, which is to dispose of the relinquished property and then start this clock. And as we see on the slide here, when that closing of the relinquished property occurs, you've got only 45 days after the date of closing to designate or identify your replacement property. Most people use the 3-property rule. Sometimes we use the 200% rule, and I can talk to you more about the specifics of those identification rules. But imagine having to make a very quick decision on what you're going to redeploy your funds into within 45 days. That's a very short period of time. You have up to 180 to complete the exchange, but only 45 to identify. And that's why having resources, financial advisors, real estate brokers that have experience and insight and wisdom can be so important because you have so limited time. And you don't perhaps have the same window on the world of potential replacement properties that these other experienced investors have.
And now, Jeff, what's a QI and why do you exist? And are you regulated, and why is it important to ask those questions?
The industry as a whole is pretty much not regulated. I'm the treasurer and on the board of the Federation of Exchange Accommodators, a trade association that's the voice of the entire 1031 industry. We are a reputable industry, but one that has been plagued by people that have had mishaps. So you do need to know who your QI is and do your due diligence, because you're basically trusting the intermediary to hold your money, to insulate you from receiving the cash proceeds so that those funds can be reinvested into the replacement property. My background, I'm an attorney, I'm an adjunct tax professor, and I am an ardent capitalist. I will tell you that I'm fiscally responsible and politically conservative. I believe in helping investors maximize their 1031s, and I go as close to the line as possible of providing information and providing tools and resources to help people be successful in their exchange. Not all qualified intermediaries are going to provide the same high level of detailed informational support as I do. Some are very good at it, and I believe that as an industry, we're a great industry, but not everyone's going to take the level of service that I do.
Get into that now, that because of time, the different, you talked about the 3 property rule, the 200% rule, 95% rule real quick. That'd be great.
3 property rule allows you to identify any 3 properties. Well, great. List property A, B, and C. The question comes up though when you're identifying a DST, a Delaware Statutory Trust, that may be comprised of multiple properties, as to whether or not you've blown the 3 property rule just by identifying a DST that has more than 3 non-contiguous parcels or properties in it. So when we're doing 1031s and we know that the client wants to go into a DST, oftentimes we'll try to get the stars into alignment so we can close on the relinquished property and then close on the replacement property within the 45-day time frame, because you're deemed to have identified everything that you acquire within the first 45 days. So if we can cash you out of the relinquished property and redeploy your funds within the 45 days, we don't have to identify. Furthermore, there's an important business reason. The quicker you get your cash reinvested into the replacement investment, the quicker you start deriving that yield and you get your money back to work for you. If we have to close on a replacement property after the 45th day, it won't be considered like kind unless it was properly identified. And we will often use the 200% rule in close concert with the financial advisor to help you designate as many potential replacement properties as we can under this value cap, which is you can't identify more properties than twice the value of your relinquished property. So you take the gross sales price of your relinquished property, double it. All of your replacement properties in aggregate can't exceed that cap. And remember, when you're buying into a levered DST, every dollar that you put into that leveraged DST equates to probably $2 of buying power, roughly speaking. So you have to look at what's the value of the interest I'm purchasing. And you can quickly break that ceiling if you're not carefully observing and computing your values.
And then we're going to jump into, with time here, Mike, if you talk about what is Boot, and just a couple quick examples that we present here and how it helps realtors. Real quickly, go ahead, Mike.
Sure. Very simply put, Boot is an exchange term of money coming out of an exchange not being reinvested. So it can be one of 2 things: cash coming out of a transaction, which is perfectly fine. You can pull cash out, it's just taxable. Or debt or mortgage relief that is not replaced. So if you had $1 million mortgage and you take out an $800,000 mortgage on the next property, there's $200,000 difference, that will be mortgage boot. So a lot of times we work in conjunction with our clients and their real estate agents. Typically their agents come to us and we help the client find solutions to do 100% exchanges or 100% tax deferrals. So in these examples on the screen, you can see there's a couple different scenarios, but the DST was just a component part of the overall solution, which allowed this hypothetical client to invest 100% of their proceeds back into real estate.
And if we can then jump into Jeff, the do's and don'ts of 1031s, if you could do that kind of quickly, that'd be great.
Well, I can try to do it quickly. Here we've got on the first line, the idea that your value has to be equivalent or greater than what you sold. So if I sell a property for $1 million and I have maybe $400,000 of equity, the client may say, I only want to reinvest my $400,000. I don't want to take on any debt. I just want to be without any encumbrances, without any debt risk. And that will result in a incredibly decreased tax efficiency. So that client that is worried about debt, doesn't want to take on debt, only wants to buy something with cash, needs to recalibrate their thinking. And the DST is the mechanism for them to reinvest their equity and pick up debt for tax purposes that they're not personally liable for. So first step is go up or equal in value. Next is you need to use an intermediary in a delayed exchange to accommodate the 1031. And basically you're hiring the qualified intermediary to do the paperwork for your exchange, but more importantly, to insulate you so you don't receive the radioactive cash proceeds from the sale of your old property. And as Mike has mentioned, the debt on your old relinquished property can be offset with either new debt that's taken out or assumed in conjunction with your purchase, or you can also offset debt relief by adding additional cash out of your own pocket. Debt relief is gross income unless you offset it with one of these two tools, new debt or new cash. Many people have misconceptions about the value, the equity, the debt requirements. They want to do what they want to do. We work with them to show them the roadmap and the parameters so they know how to accomplish it. They may not like the rules, but at least they'll understand what they are so they can conform their behavior to get the best tax deferral.
And one of the aspects of these DSTs, maybe Mike, you want to highlight, why would you want to get a DST with like an 80-20 loan to value or no debt at all? What like at any one time, why would you do that?
Sure. So DST is like any real estate, come in all different shapes and forms. So you can have DSTs that don't have any debt on them. Obviously, that's the most conservative way to own real estate. If you don't have debt under your relinquished property or the property you sold, you don't need to take on debt. So we have a lot of clients that just say, I understand that debt can leverage my return, but it's not for me. That's okay. A lot of clients have debt on properties they're selling, so we need to work within the parameters of the debt. If they have 40% loan to value, pretty easy to work with. But we also have clients and are seeing more of this as of late where they have very high loan to values. Maybe they bought a property and it didn't appreciate in value or they mismanaged it. So they might have 20% equity, 80% debt. Inland does a great job of trying to have kind of something for everyone out there, and they have high leverage programs that can help solve for debt issues. I have a client I just worked with in that exact situation. He needed 83% debt. He couldn't get a loan. He couldn't find anything else. So when I started talking to him, about 5 minutes in the conversation, he basically said, Mike, I get this. I'm probably going to do this or pay taxes, aren't I? And I said, I didn't want to say that to you, but that's exactly what was happening there. So there are solutions out there that are passive, but also can solve for complex problems that you might have or your clients might have.
And people might have mortgage over basis, not because they're poor managers or the property was bad. It's because they've refinanced out their equity to go and do other deals. And so they've laden this property with a lot of debt, and that makes it really hard to do a 1031 exchange unless you're going into a non-recourse levered DST, because if you don't have a lot of equity, it's hard to convince a traditional lender to let you buy an equivalent or greater valued property when you're kind of minimal on the skin in the game. You don't have a lot of cash to put in.
So I'm going to try to go through these kind of quickly so we can try to maybe have time for questions. But again, so these are some of the reasons why a realtor would want the benefits of DSTs. No management responsibilities. We talked about how your clients can get rid of the toilets, trash, and tenants and go into more of a passive opportunity to live their lives. You have access, as Jeff said, to the institutional quality properties. Inland goes out and buys a $100 million apartment complex, and boom, your clients have the ability to get into something like that. Lower personal liability. Do you two want to mention why that's important?
You know, it's hard to borrow money if you've got a lot of debt on your balance sheet. And so for some of our clients, they like the idea of moving their debt off of their book and into a non-recourse DST, because if they are entrepreneurial, their lenders look at their balance sheet and say, well, you don't have any personal recourse on these loans, so we're not counting those against you in computing your ability to do other transactions. So a lot of people love the non-recourse nature of the DSTs, particularly the inland DSTs, because they have the increased ability to borrow. And for some of them, it's just the ability to sleep at night, knowing that they're not personally on the hook for that debt.
And then realtors don't want to get sidelined. We had a couple in Manhattan that ran a deli. They needed the deli for income, but they sold their deli. They would have gotten killed with capital gains. So they were really slaves to the deli. When they met a guy like Mike, a financial advisor, he explained a DST, and they're like, oh my God, we can sell now. So the realtor actually got a commission for being able to sell this property. But more importantly, the client was saved because they got the income from the DST. And so that's a great way to get a client off the sideline for a realtor. And then estate planning, Jeff and Mike, why? Obviously, this is one of the big deals, especially farmers love this too, but talk about estate planning for a couple minutes.
Sure. Well, I'm just gonna hit your previous slide for just a second and just say, this opens up and loosens up inventory that wouldn't otherwise sell, because people are locked into their properties and feel that they can never sell because they would get slammed with taxes. And so having this vehicle that allows them to take their equity out and move it to something else, it's good for the client, it's good for the United States, because we don't have properties sitting stagnant, underutilized, and we're creating more velocity in the marketplace. I'm gonna let Mike hit the defer strategy. Coined by me.
Yeah, I got it from you. So to Jeff's point there, our primary role when we're working with real estate agents and brokers is to help them look good. And we get in front of or with them in front of a client, and our primary focus is educating the client on options. And when we do that, they see this solution which frees up listings. So I get calls every day from real estate agents really across the country saying, Mike, can you talk to a client? And we love that phone call. We love to help because if we can educate those clients about what we're talking about today, most of them, if it's a good fit, will then say, great, I'm willing to sign the listing agreement. So unfortunately, a DST is a security and we can't directly pay a real estate agent or broker, but we can help them get listings and we can work hand in hand. You can be, the fourth kind of leg of this stool, if you will, on our team to help clients and help the United States, as Jeff says. So real quickly on estate planning, we talk about tax deferral, we talk about income, which are very important in later stages of life. But this preservation of principal, not paying that money to the government, is very, very important because that's a guaranteed loss on the sale of our real estate. We are not going to see that money. So if we can preserve that principal, have it work for us through our lifetime, that's to benefit us. Most of our clients don't actually need access to this money because they've created their wealth. They're trying to transition that wealth through their estate. And the third leg of that stool is you receive a step-up in basis upon passing on any real estate that you own. So what that means is your kids or your heirs can inherit that real estate on the day of death. they could sell it the next day for that price that it was worth and pay 0 taxes on it. So as Jeff was saying, there's an adage out there, I'll give Jeff credit for it. It's defer, 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 and die. It's a very simple way to avoid taxes.
Take those appreciated gains to the grave and pass the property on to your heirs with a stepped up basis. And you know what, Mike, what if they don't sell that property the day after the funeral? For the accountants that are listening in, imagine this. A client receives a DST interest and they get a stepped up basis. What's the tax efficiency of those payments that they receive when now their basis in the DST has been increased to fair market value? The after-tax treatment of those yield payments will be greatly enhanced because they get to take new tax deductions for the depreciation on the underlying assets. I wouldn't sell the property the day after the funeral. I'd stay in the DST and receive that tax-efficient income. Beautiful.
Good point. And most of our clients, once they're educated, they like the DST and they do that.
Let me jump in real because we have time. Insurance policy is the last thing I'll just highlight. When I did this presentation at the Texas Association of Realtors, I had a broker come up to me afterwards and said, "Oh my gosh, I lost my best friend." I said, "Did he die?" No, I was his broker. I sold his ranch for $14 million. And then the deal I was getting him into blew up, and my friend lost it, or we lost it, and he had to pay $4 million in taxes, which meant that he wasn't my best friend anymore. He won't talk to me anymore. And he said, if I knew about this DST, I could have put it down as my second property. So I didn't put anything else down, and I would have saved my friends paying for the capital gain. So it's important to realize that you can work with Jeff and Mike, and they can explain how you just put that down. It doesn't cost anything, and really, from a matter of practice, it should just be standard operating procedure. When you do a 1031, you get a DST and you put it down as your backup, right, guys?
If you've got an open slot on the identification form, it would be a waste to leave that slot blank when you can fill in a DST, provided you understand you don't want to break the 3 property rule or the 200% rule. So you do want to work with your financial planner and your accountant and your qualified intermediary to create that insurance policy, because things happen. Murphy's Law happens. You want to have a backup property.
Do we have time for any questions? We got about 2 minutes. Mike, did you want to?
I think there's a question that popped up probably for Jeff about, do cabins qualify?
In Minnesota, you're in hostile territory because the Minnesota Department of Revenue loves to scrutinize lakeshore cabins and second homes. They are skeptical that they're truly held for investment or business purposes. But let's say that you have a cabin, you don't use it extensively for personal use, and you have it in a rental pool where you're renting it out extensively. There are properties on the North Shore and around Madeline Island that are used primarily for investment or business, and those definitely qualify for 1031. What doesn't qualify for 1031 is your second home, your personal use property, because it's not held for investment or business. There's a case called Moore v. Commissioner, which if we had more time, I'd go into. But give me a call if you've got questions about peculiar properties that are kind of on the fringe.
And I think we're at our time here. So it's been an hour. Lori, did you have any other questions that we should answer? Could we go on a little bit more?
I don't see any, but I don't see why, if people have questions, why they shouldn't ask them. I have time if you have time.
Yeah, sure. And Jeff, is there anything else in your experience that you'd like to let the listeners know about? Mike.
I think that planning is the key to success. You need to plan to succeed, and you want to build your team. So having a discussion with Mike early in the process, having your qualified intermediary, which is what I do, selected, bringing the group together. So you assemble your accountant, your lawyer, your financial advisor, your intermediary, assembling the team. People that are successful fill their deficits by utilizing their financial advisor and their attorney and their accountant when they need them. People that try to do this by the seat of their pants, it often doesn't work out as well as they think. And here's the sad story. Probably every week, I get a phone call from somebody that sold a property and didn't have a qualified intermediary in place. They have received the cash proceeds, and now they want to do a 1031. And it's a very uncomfortable situation to say, you have walked off the dock. You have made the terrible mistake of not thinking ahead and having your qualified intermediary in place before closing. And then they point the finger at their real estate agent and say, why didn't you tell me about this? I wanted to do a 1031. Why didn't you tell me about this? So
Jeff, I might be making this up, but was there a case out there at one point where a real estate agent was sued for not telling their client about an exchange?
I was an attorney. An
Okay.
attorney was sued for malpractice because he knew they wanted to sell Blackacre and buy Whiteacre and never mentioned it to him, just let him slide right through, never mentioning the 1031.
And in regards to realtors looking like rock stars with their clients, you guys probably wants to get the commission on, they get the commission on the first leg, then the second leg, and if there's money left over, how often do realtors ask for like the boot to be able to get the scraps to put into a DST? Because now their client doesn't have to pay taxes; they get to get benefit into the DST, and they get a return. Has that happened with you guys? Has that been a positive experience for realtors?
Absolutely. I'm working on a couple today. It happens all the time. And like I said earlier, for us in our business is about education. DSTs are a great fit for certain people. They're not for others. So we work to educate the client about that. And if they like real estate and that's how they've created wealth, who am I to tell them not to go into real estate? I'm just here to give them other options. And as Jeff said, if you can fill up those slots in your ID, you should. So a lot of times I have clients that say, I'm sick of management. All I want is a DST. We have a lot of clients that say, hey, I'm looking to buy this property. And if I can get my price, it makes sense. But if it doesn't, I want to do DSTs. And we'll work together with the agent and do that. And we're not here to step on anyone's toes. We're here to we have a saying around the office is what goes around comes around. So you just treat people right and good things tend to happen. So
yeah, there's a question for Jeff. How long do you have to be an owner occupied in Minnesota to qualify for a home?
I'm not sure what the question is, owner occupied. It sounds like they're asking about the principal residence exclusion under section 121. That's a different code section that gives an exclusion of up to $500,000 of gain when you sell your principal residence if you're married, filing a joint tax return, or up to $250,000 for a single filer. That is a little bit of a different method, a different way of stimulating real estate values and helping Americans accumulate wealth in real estate, but that really relates to the principal residence. Does not help the properties that are held for investment or business, because 1031 is really the tool to use for your investment or business properties, whereas section 121, the principal residence, is really for your personal use primary residence.
How long do you have to hold a second home for?
The second home is just, it's kind of like the misfit. It doesn't fit into 1031 because it's not held for investment or business purposes. And it doesn't necessarily fit into the paradigm of the principal residence because people don't use it as their personal residence. So the second home is a mismatch. It doesn't generally qualify for preferential tax treatment from either code section. And so if you do have a second home, maybe you want to rehabilitate that so it fits into one of those categories. Maybe you stop using it extensively for personal use and shift it into the 1031 category by rehabilitating it as an investment property. Or alternatively, you could move to your cabin and make it your principal residence. During this COVID pandemic, a lot of people have moved to their cabins because they want to socially distance. Why not change your voter registration, your driver's license, and make the cabin your primary residence for 2 years so that you can sell it and take the exclusion?
Interesting. Well, and then Lori, I know there's people asking how to get a hold of these guys. You don't need to get a hold of them. The most important folks are Jeff and Mike. You're gonna give everybody you're gonna send the emails and they'll be able to send stuff to folks. Is that right, Lori?
Yeah, I was just going to ask if it's okay if I could just add their emails right here, and then I know after, they will, you guys will have access to their emails as well. Is that okay?
Yeah,
Add it
Lori,
right here.
I'll type mine in. Oops.
Perfect.
Right now.
Lori, can you send?
Or
You send the
go ahead.
people that have gotten on this today. Can you send the emails to Mike and to Jeff, and then they can send them more information?
Absolutely.
Perfect. It's great. Well,
I just added my contact for everyone there.
Lori, we love this opportunity. How many people ended up on the call today, Lori?
We started out with closer to 50, and then just recently some are falling off, but they know that this is recorded and that they can access it as well.
Well, we thank the Minnesota Association of Realtors. We thank you, Lori, for all your hard work to make this happen. And of course, the leadership team of the Minnesota Realtors, thank you for your volunteering to make Minnesota a great place for realtors. And obviously the staff, we appreciate you. And I got to tell you, it was so cool. Jeff, you're like the Yoda of this 1031 stuff. You really know your stuff. And Mike, you know your stuff about the DST. So it's an honor to participate today and to be part of education. And so thank you all for taking your time and your expertise. And Lori Gans, you know how to organize stuff. You're a rock star. So thank you so much.
Oh, fantastic. And thank you all for this. This is really fantastic. And I look forward to working with all three of you in the future.
Thanks. All right. God
Thank
bless.
you.
Thanks, everyone.
Bye-bye.